Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is Joe Halpern, who's the CEO of Exceed Investments. Joe, it's great to have you back at the MarketSite with me. And we have some good news. There's a Catalyst Exceed Defined Shield Fund, that's ticker SHIIX. Just got 4 stars. Tell us about that.
Yeah, thank you very much. We're very excited. So the company was really founded to bring a lot of innovation to the space. And advisors want innovation, but they also want time. They want to make sure that investment actually works, and they want it to be through a couple cycles. So really excited about getting to that 3-year mark to really illustrate the innovation of the strategies, which is to give a more defined exposure to the markets, essentially combining the best elements of structured notes and some other bank-issued products with mutual funds. And we've been able to illustrate that through both the 3-year track record and getting a 4-star on Morningstars, which is, exciting stuff.
All right, let's talk about the fund specifically. What does SHIIX aim to achieve?
Sure. So it is a equity hedged tail risk product. We look to really protect you from the real scary events like a 2008, 2001, etc. And it does this by being a bit more defined than your traditional mutual fund out there that looks to provide an equity hedge. So what we do is, on an annual basis, we look to provide a floor of 12.5% on the S&P 500. And in return for providing that floor, we cap you up 15. So what happens is there's a real nice definition of what you should expect on an annual basis.
All right, and then the other fund is the Catalyst Exceed Defined Risk Fund. This is ticker CLPFX. What's the difference between well, let's talk about the fund first. What is that one all about? And then we'll talk about the difference between the two.
Sure. We're excited about this one too, and we just partnered with Catalyst about a year ago and launched this product. And what this product does is it provides a buffer. So it looks to protect on the first 10% while providing enhanced participation up to a cap. And what's really interesting about this product is that there's a number of other products, again, on the issuance side, which are really popular. So I'll give you a few facts, Jill. In the annuity space, one of the fastest growing annuities out there is a buffered annuity. Last year, they topped $9 billion, and it was a sector of the industry that just started at the end of 2010. So in 7 years, they got over $9 billion. It's the fastest growing area, and we're essentially doing the same thing that we're doing. We're using the same underlying engineering mechanism to create this product. So we're excited about that one as well.
So what's the difference between defined shield and defined risk?
So the defined shield product looks to provide a floor. It's really a tail risk product, right? And so what it wants to do is really limit you down under a certain amount. If the S&P goes down dramatically, you stop losing. The buffered note product, right, which is the defined risk product, that one really looks to provide a buffer. So it looks to protect a first loss instance. So let's say the first 10% of the market, which is what our product does. And in that instance, if the market over a year is down 10%, our product will be around, down around 0. But you will take larger losses if the market goes down dramatically.
All right. And what type of investors are these strategies and funds appropriate for?
Sure. So they really work well for that conservative investor. I'd say there's kind of 2 groups. But if you think of that, going back to that $9 billion annuity example, right, a lot of people there are getting towards the end of their careers, and they're looking to really provide themselves a little bit more protection from a serious downturn. And so both these products can be used as an allocation within a conservative exposure. Some people, which is interesting, use a little bit of it as a core satellite, where they take a bit more of a conservative exposure with our products and surround it with some of the other products that might be a little bit more aggressive.
So where have investors used these types of products historically? Does that go back to the annuity product you had mentioned? Yeah,
so both structured notes and annuities. If you look at the structured note industry, it's a $2 trillion global industry. Lots of buffered notes, one of the most popular product out there. And then tail risk products, very popular as well. Protection and partial protection products are very large. And the innovation, the reason we came out, right, Exceed, because I used to do that. I used to work at the banks and create these sort of products, was really to take an innovative approach to these products, because while I believe they provide a very high level of definition and they're appropriate for certain portions of the portfolio, they're very hard to use within models. They're very hard to implement. You have to get sign-off on a lot of documents. There's minimum sizes, there's no liquidity. And so we really wanted to solve for that. And that's what we did by taking some of these beneficial elements and essentially engineering in a very similar way, but putting it into an open-ended structure and again, based on an index or a family of indices where we partnered with Nasdaq on. So we were really excited to bring this innovation to market, where we're able to much easier, provide a tool to define an exposure and implement within a model portfolio, manage within a model portfolio, and have that daily liquidity at NAV. And then just kind of going full circle, we're excited to get to a 3-year mark, and we're excited with the partners we have with both Catalyst and Nasdaq in helping us kind of, pave the way and get advisors,
Right. And excited to get the 4 stars too. That's the exciting part.
That's right. You can't forget about the 4 stars. I mean, the 4 stars just proves out that, we're able to perform the way expected.
All right. And to wrap up, since we have you here, what's your market outlook for 2018? Because it definitely feels different than it did in 2017.
Oh boy, it really does,
Yeah.
huh? So we spoke a little bit about this in our market letter at the end of the year, where we said 2017 was a lot. You had to go all the way back to the 60s to see that sort of volatility. The regime's really changed, as we've seen, and I think it's been really good for investors to see this, because sometimes investors get a little bit complacent with how the market's feeling, and low volatility seems this is a really nice ride. The truth is, this environment is more how the market generally is, and I foresee more of it going forward. In other words, more volatility in the market, more of what we've been going with in terms of whipsaws in the market, and a little bit of a tougher market environment. And then I'll go so far as to say there's, it's a few geopolitical things out there where, one thing goes wrong, or you could easily have a political event happen where you could have a real downturn that could be, kind of scary, maybe even scarier than what we saw in February. So that's what I kind of see.
All right. Well, thank you very much for joining us at MarketSite, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.